Nobody starts out perfect unless you believe you were born that way. The same logic goes for investing. You're bound to make mistakes no matter how much you study. Experience and expertise come with a series of big failures and bigger successes. That's how people get better every time at something. Each time they learn from their mistakes and start off better, so long as they have the tenacity to keep coming back. So what's the number one mistake most people do that the mega wealthy don't? Giving up too early. We get it, investing can get pretty scary when you're starting off. Knowing the risks and potential losses, it's not unusual for a lot of people to back down before even getting started. But investing doesn't have to be that complicated. Welcome to Luxo-Life, your partner toward personal growth and success. Today, we're going to expose the most frequent investing mistakes that you might encounter on the road to financial freedom and wealth, what most people do, and what the mega wealthy would do instead. All these to help you avoid these top investing mistakes that could put you out of your game. But once more, even if you are found guilty, fret not. It's never too late to make things right. First off, let's get to know who the mega wealthy are, what these rich individuals do to grow and safeguard their wealth, and what they don't do that you're probably thinking of doing. Another commonly used term for the mega wealthy is ultra high net worth individuals, or UHNWIs for short. This collective group doesn't just refer to the richest people in the world, but it's specific to individuals whose net worths are over $30 million. When we say net worth, we're not just referring to a person's value in stocks, but rather the sum of their entire assets, including but not limited to real estate, vehicles, companies, personal investments, art, and other properties. Looking at the lives of these people in VIP lounges, 5-star hotels, and private jets, we would often assume that besides generational wealth, hard work, or tenacity, their wealth may have been a result of some super smart and super secret investing strategy that only the chosen few know. But fortunately for you and I, that's not it. Rather, the mega wealthy simply know where to put their money and when. As one of Warren Buffett's most famous quotes, the number one rule of investing is to never lose money. Does that mean you shouldn't invest at all? No, that means you should also know where to put your money so that it doesn't count as loss. Spending money on things without any value like car rentals to impress your friends or Gucci swag is counted as losses. But investing in stocks, REITs, and good quality food, these things hold true value in the long term. So that's where we're going to start off with number 6, following the trends. This goes two ways. The first one is following the market trend. Now, we're all aware that it's natural to start buying during bear markets due to lower price stocks and start selling during bull markets when the prices are higher. Still, these trends don't always have to apply to everyone, especially if you have specific investment goals and strategies. If your aim is to promote long-term growth without having to actively manage your portfolio, then you might feel more comfortable just buying stocks during a bear market and holding onto them as bull markets reach their peak. But if your aim is to profit big and have no problems managing your portfolio and trading by the minute, then active buying and selling of stocks during bull markets may suit you better. It simply depends on your goals, so you don't always have to follow suit with what everyone else is doing during these trends, but rather stick to what you're aiming for and follow the system of your goals. The second way is to follow the investing trend of your buddies. A common thing for smaller investors to do is to compare themselves to their peers and how they are doing in comparison. That leads to them trying to match or beat the investment strategies of their friends and some investors who are more experienced than them. Bob bought a private equity share. Should you also get one? Carol bought a piece of real estate rental property. Should you also buy one? Here's the deal, your goals may not be exactly the same as your rich pals, so you don't have to compete with them all the time. It only becomes a distraction if you perceive your peers as somewhat of a measuring rod or golden standard for your own goals and status. Focus on yourself and your personal investments, and don't just follow the trend everyone else is set on. You are your own standard, and you must focus on getting better than you were the day before. Number 5. Ignoring your savings and emergency funds. It's easy to get caught up in the business of building wealth, so much that you end up investing most of your hard-earned money and not leaving much for your savings and emergency funds. These two facets of your finances are crucial to your survival and wealth-building strategy. Saving doesn't mean not spending any money at all. To the mega wealthy, saving is about where to store your money when you need it the most. Not only that, but saving can also mean living below your means. By slowly increasing your cash inflow and dramatically reducing your cash outflow, you're more likely to succeed in building your wealth no matter how little you have right now. That doesn't mean you ought not to enjoy and treat yourself once in a while. As long as you've got your savings and investments in check, you're free to use your extra funds. Preparing an emergency fund is also important, as this allows you a space of security and recovery when tough times hit. Accidents, emergencies, calamities, inflation, and like occasions are some of the reasons why you should keep an emergency fund enough to keep you alive and well for 6 months or so. Number 4. Failing to adjust your investment strategies. Do the same thing the same way all the time, and you're certain to lose efficiency in the long run. What most people believe about investing is that you invest a little bit here and a little bit there. You let them run their course for the next year or two, and everything's gonna be alright. Well, that might work for some, but the ultra-rich are always keen on analyzing new and current market trends to get an idea of what to do next with their portfolio. This is called portfolio rebalancing, in which investors tweak and reallocate their investments in vehicles that have better chances of succeeding and benefiting them under current circumstances than previously known strategies. Rebalancing your portfolio can be as easy as checking on the current state of your investments and exploring new strategies for the next big market trend. Or if you're really into it, you can analyze previous market data and reallocate or reinvest your funds into new investment vehicles. However you plan to adjust your portfolio and strategies, and how frequently you do this is all up to you. The purpose of this strategy is to actively manage and safeguard your portfolio for upcoming trends that could either benefit you or cost you. Preparation is key, and this becomes an even greater necessity if you're purposing to profit big from your investments in the next 10 or 20 years. Number 3. Investing only nationally. Of course, it's common knowledge that the United States and European markets often offer the best securities in the market, being highly developed countries. But wise investors don't just look at what's in front of them, they look way beyond these tried and tested markets. As the saying goes, take the path where few people go. This means that the top investors are also attracted to innovative and emerging markets. Thriving countries like Singapore, New Zealand, and India are some of the horizons that investors are looking into. Number 2. Investing only in liquid assets. Beyond cross-country investments, investors who only put their money on intangible numbers are considered narrow-minded. When it comes to investing, people would immediately think of stocks and bonds, but despite offering lower price ranges, higher liquidities, and fewer complications, they seldom remain the best asset for your investment goals, and the mega wealthy are aware of that. They're also aware of the value of tangible, physical assets like real estate, gold, collectibles, antiques, and art. Physical assets are vital to any effectively diversified portfolio. Real estate is a benchmark that sets successful investors apart from newbies, and while they may be the toughest investment to handle, the rewards and profits earned from this form of investment are usually worth the work. Gold is a common physical asset that a lot of investors come running to during an economic crisis, as it tends to retain its value better than modern currencies. Other physical assets include collectibles, antiques, and even art pieces that accumulate value the rarer and older they become. Unfortunately, physical assets like these often scare away beginner investors because their liquidity is more limited than that of stocks and bonds, and they are often more expensive as well. However, if you get to purchase some of these physical assets and handle them well, you will be faithfully rewarded. Number 1. Investing only in public stock markets. Another mistake the mega wealthy would never make is focusing the majority of their investments on public markets. For most of them, the real game changer is private equities. There's a higher chance of capital appreciation from owning private businesses or even a part of the whole pie than buying common stocks from public markets. If your plan in life is to be one of the ultra-wealthy, investing is not an activity that you would want to miss out on. Investing is highly essential in the process of becoming financially successful. But sometimes people get too excited over investing that they become prone to these common mistakes that only hurt their portfolio. For this reason, setting goals, developing a financial plan, following an effective investment system, and maintaining the right mindset are all important steps toward achieving financial success. With that said, what other mistakes do you think investors avoid? Share your thoughts with us in the comments section, and don't forget to leave us a thumbs up while subscribing to the channel for more awesome and educational videos.